Okay, let's welcome on board then Pankaj Pandey and find about where the opportunities to invest or perhaps profit take are. Pankaj, hi, good morning. Good to have you on the show. Where would you scout opportunities to buy in, or would you say wait it out because you don't know where this correction is headed?
Yeah, hi, good morning. I think our sense is that typically the defensives is the only pack wherein the earning disruption is the least, especially IT and pharma. And in IT and pharma, you have a lot more structural legs also going into some segments, and which is where we believe that any kind of a correction should be used as an opportunity to buy. I think besides that, probably banking looks quite attractive to us, especially private banks, because our sense is that largely the price correction is largely done. I think what is still not clear whether we'll see a 5% kind of a restructuring or 8% kind of a restructuring. So if we were to sort of see 5% kind of a restructuring, the overall credit cost could be about 50 pips for the industry. But for private banks, it will be a lot more lesser, which means that private banks, especially HDFC Bank and Kotak Bank, I think should do a lot more better. And I think beside that, telecom also has seen a decent amount of crack. Our sense is that overall going forward, whether Voda remains or not, largely we would see a better pricing scenario going forward. And that is positive for a stock like Bharti. So I think IT and pharma, besides that, banking and telecom is what one has to look at. I think capital intensive sectors or commodity oriented sectors clearly need to sort of, one needs to sort of stay away, especially from an investment perspective.
Kunal, is that your sense as well? Because before yesterday's correction, everyone was looking at metals as a play for the next 3 to 6 months. Would you say right now steer clear because you don't know globally which way things may be headed, and the big fear about a second wave and spate of lockdowns may be coming up next, and that's going to definitely impact the metal trade once again?
So, I believe that there are two things over here, Aisha, which is very important. One is from a very near-term view that there's a risk off mode which is happening, in many global markets. And when you generally see risk off mode, the high beta sectors and the rate sensitive sectors are typically the ones where you see either profit booking or you see a wave of downtrend in the prices. So I think the metal stocks are at the brunt of that kind of a selling pressure because of the spate of risk off which is happening. Now the second attribute is you need to understand that what was probably the major cause of the rally in the metal stocks. It was primarily dollar index which was cracking. So from I think 103, 104 levels, dollar index at one point was just on the verge of breaking that 90 odd levels as well. So it had come very close towards those kind of a corrective phase. Now that was primarily one of the key reasons why you saw metal prices started to rally, and as now the dollar index sell off intensified, we saw the metal rally also intensify in the similar vein. So now what has happened is the dollar index has started to rally up again. So I think there are some signs of divergences which have come across, and I think the dollar index is now back towards 93 and a half, I think at the last count plus level. So because of this rally in dollar index, there's also more pressure into these metal stocks, and the ones which had rallied up significantly higher, so 3x 4x returns in a few of these metal stocks, and that's where you're seeing some sharp reversal pressure going forward. So I believe that this is a phase of temporary adjustment, whether the dollar index, how far the dollar index can probably rally, whether this is just a short-term rally or whether this is a new trend in the making. I believe on the back of this risk-off mode and the rally in the dollar index, you're seeing pressure in the metal stocks, which I believe could be purely short-term or temporary phase.
Okay, let's get a move on and tell you about the stocks to keep an eye out on in today's trading session. We begin then with Piramal Enterprises that's in focus. Economic Times reports indicate that buyout fund Apollo Global Management as well as Renuka Ramnath's Multiples Alternate Asset Management, they have entered the race to acquire Piramal Group's glass business that is considered the Asia's biggest for specialty products. Remember, now this, according to reports, is joining Blackstone as well as Partners Group holding AG for the business, which could be in the range of 7,000 to 8,000 crore rupees. Meantime, Coal India plans to reach 1 billion ton production by FY 23-24, and if reached, this will mean a CAGR of 13.5% from the FY 20 level of about 602 million tons. Meantime, Route Mobile, remember it was a stellar listing, and here are some of the key funds and entities that have bought in. PRB Securities buys about 2 lakh shares. The Goldman Sachs India Fund about 4.7 lakh shares at 705. The Goldman Sachs Trust Emerging Market Equity Fund buys 8 lakh shares. You've got Kuwait Investment Authority as well buying about 5.78 lakh shares. Oberoi Realty is on Goldman Sachs' radar. They maintain a buy with a target price of 465, saying that it has a relatively stronger MMR demand for ready-to-move inventory. The new launch absorption continues to lag, but there has been strong sequential improvement in the month of July, and pricing has remained largely flat across markets. Kotak Bank as well is on Morgan Stanley's radar, an overweight rating here with a target price at 1475. They say the bank has highlighted moderation in the pace of economic improvement in the recent months. For growth, the outlook does remain tough. Margins could be under pressure, but the collection efficiency in September 2020 to date has improved. There are your top 5 stocks. Let's find out some mid-cap strategies too then from our chartists. And Dr. Narayan, what's the word? Is it a sell recommendation from the mid-caps?
Well, it is, and it is on PVR where I've remained a little bearish and I've given sell calls earlier. I find that PVR continues its bearish positioning on the charts, and therefore I would reiterate another sell call on PVR now with a new target lower at about 1075. And on this new trade, one can probably keep a stop loss at 1125.
Okay, PVR it is, a sell recommendation. Kunal, what is it that's standing out on the charts according to you?
Well, it's a sell call and a sell on Federal Bank. That stock also managing to show some signs of weakness. So it was trading in the band of 50 and 55 for over the last 1.5 odd month. But yesterday the stock managed to break below its 50 level, so it was one of the major supports as such for Federal Bank, which got breached. So I would expect there would be more follow through selling into this stock as well. Hence a short, and targets to be kept at 47 and stop loss at 52.
All right, great. Pankaj Pandey, let's get some more views from him as well. Pankaj, in terms of some of the IT names that have been standing out, in particular, I guess it's been an HCL, partially news driven, of course, followed by some of the mid caps as well. Within the IT names, how would you stack them up in terms of preference?
So in IT, largely overall, last quarter has been pretty good, and what is sort of clearly coming out is that you will see larger IT spends going forward. But the only challenge is that the markets have sort of priced in that particular aspect for most of the stocks. So, for example, TCS, the multiples have gone up from nearly 21 times to 26 times. For something like HCL Tech and Wipro, it has gone up from 12 to 17 odd times. I think the quantification of the virtualization of business and the higher IT spend is yet to sort of come. But I think if we see a crack in any of these tier 1 and tier 2 names, I think that those are the ones what one has to sort of look at. Because our sense is that that the companies, if they're able to deliver higher growth, then I think IT is here to stay or is expected to keep doing better. So whether it is TCS post-correction or Infi post-correction, I think all these stocks or tier 1, tier 2 names can be looked at. See, the only challenge is that the markets have already priced in. So in case if we sort of get a correction in the next few days, I think all your tier 1 and tier 2 names make a good case. At this point in time, all of them look fully valued, given the fact that a re-rating on the P multiple side has already happened.
We haven't talked about FMCG consumption in a while, and sure, the narrative was that they're expensive, overvalued, and so forth. But on any dips, would they still be names to get into from a longer term perspective? Because in that sense, they've been steady performers. Would you still be looking at anything in that space, or would you just find better opportunities in the market right now?
We can still look at some stocks from a bottom-up perspective, because typically all your tier 1 names like say Nestle, Asian Paints, all of them are trading at nearly 60 times on FY22 basis. But I think what we like is something like Dabur, which is trading at 46 times. What we have seen is that the immunity-based products have witnessed a good growth. We like Zydus also with a target price of 2,300. Our sense is that so whatever brands they've acquired, they can sort of keep growing at 8 to 10 odd percent. The company has got good gross margins, so probably they can sort of spend on building brands. And then for the fundraising will curtail down their debt. And that should lead to a higher EPS growth. Profit growth, and that because of that, we would expect that the stock will do well. It is trading at about 24-25 times on FY22 basis, and we believe that compared to the rest of the pack, it can easily command about 35 times, which is where we have valued it at 2,300.
Okay, great. Let's also get your perspective from Sanjeev Mehta. We were in conversation with him yesterday on the outlook going forward. Listen in.
Yes, to a large extent, the supply problems are behind us, the serious supply problems. But even today, we do have what I would call as the vertical lockdowns, which does hamper both supply chain from a back-end perspective as well as distribution. We have to accept that supply chain works in a very synchronized manner. So even if there is a pocket of disruption, if one supplier or two suppliers, they get disrupted, then the whole chain gets impacted. So while we are no longer, say, in the scenario of April or early May, and we've come a long way from there, and from a gross perspective, gross tonnage perspective, gross volume perspective, I think we are back to normative levels. Okay. Having said that, the demand patterns are different. Demand pattern for what I call as the COVID obsessive categories, like sanitizers and hand wash liquids, they have been very robust. Then on the other extreme,
Pankaj, if somebody has to, let's say, make a portfolio of only 5 stocks for next 3 years, which are the 2-3 stocks you think they should be in that 5-stock portfolio?
So again, depends on the overall kind of opportunity, but our sense is that the defensives are going to witness the least amount of earning disruption. So which is where the bulk of the names have to come from IT and pharma. Say, for example, in pharma, you have entire gamut of opportunities which are sort of looking attractive. But I think what is something structural is, say, for example, the contract manufacturing side, wherein if you look at most of the companies are now trading at 10 kind of a sales on a forward basis. So Syngene is a sort of a classic example for a good CRAMS or a CDMO play. Our sense is that globally, companies in this domain command a lot more higher multiple, and which is where something like Syngene or something like Suven Pharma, I think, look quite attractive. I think in IT, the tier 1 names are looking good. So both TCS and Infi, our sense is that because of virtualization of businesses, while there has been some bit of a re-rating, but any kind of a crack, I think, is an opportunity to buy in these stocks. Besides that, I think telecom, Bharti looks quite attractive to us, given the correction it has already seen. Because our sense is that going forward, we'll see a better pricing scenario going forward. And so that way, I think these would be the 4-5 names, I think, are likely to do well. I think overall, sectorally, you have a lot more names one can sort of talk about. But a lot depends on what customers are looking or what investors are looking at.
I want to go back to Bharti, Pankaj. What is the concern for Bharti? Is it over ownership, or is it the inability to increase price? I mean, frankly, Pankaj, we may talk about a scenario where Bharti will benefit because of data consumption, but the facts are pointing to a different direction. They are not able to take a price hike, and the ARPUs have not gone up significantly. So while the big picture is great, but the big picture is not translated into some real strength for Bharti and their shareholders.
Correct. So I think one of the concerns for Bharti is that probably Jio is slightly ahead in terms of 5G infrastructure or the kind of spend what they can do. But our sense is that from a medium-term perspective, pricing is something we would be sort of more hopeful of recovery, largely because with the kind of money which has been attracted in Jio, our sense is that for that money to become remunerative, the price hike needs to happen, and which is where our sense is that that will benefit Bharati also. While near term we have seen a decent amount of crack, but I think that's a decent opportunity to buy. I think what is still not clear whether what kind of impact Vodafone would have in this scenario. So I think with Vodafone or without Vodafone, still I believe we believe that Bharti makes a good case. At least with the correction, the risk reward is quite favorable.
Okay, let's detour for a bit. And the Cabinet Committee on Economic Affairs, chaired by Prime Minister Narendra Modi himself, has approved an increase in MSP for Rabi crops for 2020 and 2021 season in the emergency meeting. The Cabinet's decision, remember, come a day after the farm bills were passed in the Rajya Sabha, which invited opposition protests in the parliament itself. Let's take it across to my colleague Karishma Asudani for more details on the same.
Relief for lakhs of farmers across areas of Punjab and Haryana who've been worried and scared, waiting for a clarity on this, especially after the kind of arguments that took place regarding the farm bill in Parliament last 2 days. Well, increase in MSP in Rabi crops, which varies from barley, wheat, from 50 rupees to that of 300 rupees per quintal, that is per 100 kg, comes as a good news, keeping in mind that, you know, this comes at the right time because mid-September, starting October, is the season of cultivation where the seeds are sowed for Rabi and Kharif. In fact, last year also the Modi government made certain kind of minimum hikes in the Rabi crops, which came as a relief for the industry, and it was expected that in mid-October this would come, but it's come a month earlier. Maybe the government wanted to put out a clarity that the concept and the mechanism of MSP will not be removed, but the government is very keen on continuing it, which also, of course, it's been trying to convey to the opposition. Well, the biggest, I think, relief also comes is to farmers in Punjab. We know that Punjab is called the wheat bowl of India, and keeping in mind that this month and the next month is going to be the season of harvest for them, I think this will of course encourage the farmers to increase the cultivation of these crops.
Okay. Okay, Karishma, we'll leave it at that. Interesting note then coming in on Aurobindo Pharma this morning, and researchers put out a note on Indian pharmaceuticals. They're saying that injectables, branded, OTC business are not quite reflected fully into the pricing of Oro Pharma, and thereby they are putting Aurobindo Pharma as the top pick within the pharma universe. Pankaj, would you also say that Oro is currently a preferred pick, because most of the others seem to be well-discovered stories?
In pharma with Dr. Reddy already sort of run up, I think Cipla looks quite attractive to us given the fact that it has a slightly more balanced portfolio compared to Aurobindo, which is largely US based. And I think Cipla is sort of making the right moves in terms of moving out from tender businesses. Then they're sort of beefing up the pipeline for the US business. So I think that looks more attractive to us, wherein we have a target price of 900. But in pharma, largely, I think structural stories with the CRAMS player, wherein DV's, Syngene, Suven Pharma, and some bit of Laurus Lab are, I think, structurally more positive.
Okay, that's the take coming in on some of the pharma names. CK, wanted your checks as well on Bharti, what we were talking about. Significant correction coming in from the highs. And then, of course, in Oro Pharma, whether you believe that once this correction actually settles, there is significant headroom present in the stock.
Well, in Bharti, we had discussed that there would be a small rally, the outside extent of which I had put at about 505, 510. And the rally did occur till about 495, 500 levels, but then it got clobbered by yesterday's price action. What has happened is that in the fall of yesterday, the stock has come and breached the previous support also, rendering the rally attempt as voided, because now it will have to rebuild all that once again to continue the rally as it were. So therefore, whatever bullish hopes that one was harboring for Bharti, that now with the selling ease the stock might go up, I think that is now put a little bit on the back burner. If it doesn't decline also, the stock might likely consolidate rather than pull back into a kind of a rally attempt. So Bharti for the time being looks completely uninteresting except for day traders or 1 or 2 day kind of traders, but certainly not of much interest for something beyond that for longer term players. Coming to Aurobindo Pharma, I think that has also had some pullback, but recent data shows that the selling is over and the stock is slowly shifting over to a rising platform that has not yet started, but very definitely the stock shows what we call as a range shift within technical parlance, and a range shift is a precursor to a possible advance at a later point of time. So this is of course caveated on the fact that the pattern does not get violated. Now, if Aurobindo remains around here without undergoing too much of a price damage, I think the range shift pattern will remain consistent, and when more appropriate conditions emerge for pharma or some news flow comes in Aurobindo, I think the response to that will be a lot more than what we normally expect. So therefore, I would have a slightly bullish bias in Aurobindo at this level and keep it on my watching radar for a buy as soon as it starts moving up.
Okay, let's get you a global view as well. Russell Napier, in an exclusive conversation with us, talks about his rationale to changing his stance to inflationist after more than 2 decades. Listen in.
That is kind of what financial repression is. And this time it's definitely coming to the West. I think the fascinating thing about India and some other key emerging markets is you may not have to do it, because actually your debt to GDP levels are at remarkably low levels by global standards. And, I think it's half, you've probably got half the level of debt to GDP that a country like the United States or the United Kingdom has. So I think one of the most fascinating things over the next 10 years is what will happen in countries like India, who may be able to get away with this. I mean, it will be a tremendously positive thing for any country that can avoid this, because you've got to remember that if we head into this scenario, it drives out savings. Savers will try to escape a situation where inflation is here and interest rates are here. And where on earth will they escape to? Because the entire developed world is in exactly the same situation. So there is a wonderful opportunity, I think, for some countries such as India.
All right, let's also listen in to S. Narain's mantra on how to get rich.
You have to remember, equity investors are residual risk beneficiaries. So I think that's why we think ESG is the right way to go. Timing is, we need periods of volatility to make. You know that in the month of March was one of the best times to invest because there was so much volatility. We always believe volatility is one of the best times to invest. And that's how we look at it. And we spent a lot of time looking at governance factors. We've spent a lot of time looking at social and environment factors. And I think this is an area where we keep learning also. It's not that learning is complete. We have more learnings to do, and that's how we look at it. And I believe that the markets itself is not in a very, very easy frame of investing at this point of time. But at the same time, there are areas where we think there are a lot of long-term investment opportunities at this point of time. And there are areas which look fully valued at this point of time. And we really like the way both retail and institutional activity has been both involved. Unlike periods of time in the last 10 years, when it was just institutions who were active and retail was not active, whereas now we have an environment where everyone is active. And that is something which I really like at this point.
Okay, let's move on. Let's tell you what's happening across the nation as well. And here's news Farafat. The Congress has announced a nationwide protest against the farm bills to collect 2 crore signatures from farmers. The meeting, called on the directions of Congress President Sonia Gandhi and former party chief Rahul Gandhi, was attended by the general secretaries and state in charges of the party. Also, Corps Commander level meeting between India and China went on for 13 hours yesterday and concluded at 11 p.m. in the night. The Indian representatives at the meeting will now brief senior officials about the discussions with the Chinese counterparts. The United Nations is facing a crisis of confidence without comprehensive reforms, Prime Minister Narendra Modi has said, asserting that the world needs a reformed multilateralism that reflects today's realities, gives voice to all its stakeholders, addresses contemporary challenges, and focuses on human welfare. Okay, 2.5% lower in trade yesterday. 259-point fall coming in for the Nifty futures, and all sectors dragging at a dismal market breadth. The pre-open rates then this morning, let's quickly revisit those because they are indicating some amount of relief, at least on the screen. About 0.4% higher for the Sensex, and that's pretty much what the Nifty as well was indicating. I don't want to quickly revisit what the SGX Nifty as well is up to and whether that was indicating any different than that. The pre-open rates seem like we're going to manage to arrest the fall, at least in today's trading session, or at least stall the fall. Kunal, going by the movers on the Nifty, what is that one stock that you're tracking which has maximum correlation to the Nifty, which is going to indicate which way the index is headed next, or a sector perhaps?
Well, it's Reliance Industries. I think that's the one-word answer for your question. I think that stock has one of the highest correlation now with respect to Nifty. We've seen, I would say good periods or good time length that whenever Reliance Industries has tried to perform and taken the charge, it's had a direct impact and direct correlation on the Nifty. And whenever we've seen selling pressure, on Reliance Industries, we've seen a similar reaction on the price action. Now, in the last few days as well, there was those intraday spikes on Reliance Industries that had a similar effect on the Nifty as well. But interestingly, the stock is not breaking below its major support level. So I think that's going to be one important sign. So on one hand, Nifty is at 11,250, 300 levels on the spot basis. Reliance Industries still is about support levels of 2,200, which I believe is a major support now for the stock price. So I think both the correlation of both of these would be something to watch out for, because any major weakness, and I'm talking of a major weakness in the stock price for Reliance Industries, I think that could have a direct impact on the Nifty or the prospects of Nifty, at least in the near to medium term.
Okay, counting down to the market open then, going by the pre-open rate, Nikunj, it seems like a little bit of respite could be in store for us, at least to start off trade with. Having said that, if a second wave of the virus actually hits and if countries do choose to extend their lockdown or go for fresh series of lockdowns, then of course it's anyone's guess how the markets are going to react this time.
Markets never react to the same thing twice. So I don't think anybody was assuming that it's going to be a May kind of a scenario or a March kind of scenario. No, it's not going to be that, because the world, everybody, all of us are prepared and much more mature in understanding the impact of the virus and what it will do to us. I sincerely hope and pray, and all of us are praying, that nothing happens, nothing dire happens. Now markets, meanwhile, Aisha, you could divide the market into two lots. Which way the pendulum is going to swing? Will it go back to the outperformers, which is Reliance, Pharma, IT? Or will this time around, if a shakeout happens, it's going to go back to high beta names? As of now, I think we are in a risk-off moment, and it's a global phenomenon where banks and metals are leading the carnage down. So one should not be in a hurry to buy banks and metals at all. If at all, I would say you got to shift out tilt between pharma and auto. Auto because it's a clear play on revival, pharma because it's a sector which is going through a exceptionally strong re-rating cycle, both in terms of fundamentals and also in terms of PE. Now, when a correction will happen, some of the overowned stocks will come down, and then you got to wait for a good entry point to buy into those stocks. Where I am slightly confused or worried or not clear is that what will happen to small and mid-cap stocks, which in a sense have really seen a trailblazing move, minus yesterday's move in last couple of days. That's where you got to watch your steps. Watch your steps in small and mid-cap stocks. Don't carry it away. This is not a market where a tip in a lift is going to make you money. I mean, imagine, Aisha, I'm just saying something very simple. When you buy a mobile phone, you do extensive analysis to buy it. Similarly, when you buy a small and a mid-cap stock, spend some time, understand the company, then only invest in it, because when the cycle is going to reverse in some of these small and mid-cap stocks, and the shakeout has already happened, it's going to be very, very nasty. So I'm not isolating small and mid-cap as a category, but I'm saying if you are a small and mid-cap investor or trader, just watch your steps. Be careful. Don't take it for granted. But I think between auto and pharma, I think these are the two pockets which will qualify in my book that you should be a buyer on decline, and you should avoid metals and banks, even though they've underperformed and they may look cheap on paper.
Okay, metals and banks. So let's see, even though it seems that we're going to manage to stall the fall from yesterday, whether or not metal and banks see a further decline coming in or not, and what really pulls or snaps the market out of this losing spree, that's something which is going to be key. On our radar, of course, is going to be the breadth of the market as well, and whether or not you see a further decline come in while the Nifty manages to arrest the fall or not, or are the two going to move in tandem with each other. That's really going to be on our focus, and whether it continues to be a Reliance, IT, Pharma combo which manages to hold up the market or manages to recoup the market from where it struck yesterday. 11,256 is where we shut shop in trade. So let's see where we head from there. Of course, the biggest losers were within the banking universe, as was the case with a lot of other Nifty heavyweights as well. What with the move coming in on Unilever and Nestle as well, even FMCG wasn't quite spared. And when it comes to banks, of course, the losers were far many. You had quite a bit of steep decline coming in for the likes of an IndusInd Bank, which shaved off about almost 9%, PNB, RBL, SBI, which was down about 3.5%, BOB, which fell pretty hard, or a Bandhan Bank and Axis. Nothing really was spared, barring a Kotak, which managed to hold its head above water. So let's see which way really the trades head, and whether or not IT manages to resist the fall or not. Given that even in trade yesterday, a slim margin, but TCS and Infosys both managed to hold themselves in the green. Not by a big bang move, but just about skirting around the green territory. That was quite a bit in yesterday's market as well. So doff your hat to that really. So that's pretty much the construct of the market, keeping our eyes on the first trade this morning. As I say on my screens, or see on my screens, 11,300 for the Nifty 50, and the Sensex has a marginal green start around 38,200 thereabout levels as we speak right now. To the Nifty Bank then, and constituents of the Nifty which are actually managing to stall the fall, or for that matter recoup where we left it off yesterday. While it's a 0.5% up in the green start, so it's good to see that. DRL is back in the game, about 1.5% higher. The breadth not looking as convincing this Tuesday morning. It's largely neck and neck, and I would say the declines are taking over, at least within the NSE constituents. You can see some green on an Infratel and a DRL and a Wipro, Grasim, Sun Pharma, Asian Paints. HDFC Bank though sees a bit of red. It's down about 0.6 of a percent. Actually, I just want to quickly bring up the Nifty Bank as well and give you a flavor of what's happening within the banking universe. Muthoot Finance is down 2%. Bandhan Bank is down roughly about 2%. I can also see some red coming in for an M&M Finance, for a Godrej Consumer Products, for a PVR. They've all started off in the red. On the flip side, you're seeing some green for HCL Technologies, for Infratel, like I mentioned, for a TechM, for Tata Chemical, and Coforge. So clearly, IT is on one end and banks on the other, and it's a bit of a tug of war happening within there. Fertilizers holding out, technology, telecom to a slim degree, some of the real estate names and textile. These are the sectors which are holding out in the green. Automobiles, banks, cap goods, FMCG, finance, infrastructure, media, metals, they're all a CF red, as is the case with pharma too, as of now at least, Nikunj.
Okay, let me now bring on board Atul Suri to talk about what the charts are saying and how should one read into the global correction and yesterday's scary sell-off. Atul, good morning. Thank you for joining us. Is the party over? Do you think we've peaked out for the year, or this is just a routine correction?
Nikunj, for a market that's up almost 55 to 60%, 57% to be precise in 6 months, a 3 to 4% decline is not like the end of the party. We can even fall